Have you ever imagined waking up one day and realizing your cash no longer exists? No notes in your pocket, no coins, no plastic cards. Every payment happens instantly through your phone, and your wallet is a digital account backed directly by your country's central bank. Most people think digital currencies and CBDCs are futuristic ideas still years away. But the truth is, they were created to solve a very real and practical problem. Cash is expensive, slow, hard to track, and increasingly disconnected from how people actually pay. To see this clearly, imagine something simple. You send money to a friend instantly using your phone, with no physical exchange and no delay. Without realizing it, that single action already follows the core logic of digital currency, money that lives entirely in technology, not paper. This is the Learning Studio, where we decode how finance is evolving before it becomes obvious to everyone else. What's really happening in that moment is straightforward. Value is being transferred electronically, verified by systems instead of physical exchange, and recorded instantly. Digital currencies take this idea further by making money itself native to digital systems rather than just a digital version of cash. That's where central bank digital currencies, or CBDCs, come in. A CBDC is a digital form of a country's official currency, issued and guaranteed by its central bank. It's not crypto, and it's not private money. It's government-backed digital cash, designed to combine the trust of traditional currency with the speed of modern technology. This isn't theory. Countries are already moving. People's Bank of China has rolled out the digital yuan in large-scale pilot programs. Reserve Bank of India has launched the digital rupee and is expanding its use. The European Central Bank is actively testing the digital euro, while the Federal Reserve is researching what a digital dollar could look like. The shift has already started, quietly, systematically, and globally. Governments are moving in this direction because digital currencies give them what cash can't: faster payments, lower transaction costs, better financial inclusion, and stronger control over illegal money flows. CBDCs combine the anonymity and reliability of cash with the traceability and efficiency of digital systems. For accounting and finance, this changes everything. Transactions can be recorded in real time. Audit trails become instant. Tax collection becomes more accurate. Cash handling, reconciliation, and physical controls start disappearing. Accountants move away from counting money and toward monitoring systems, ensuring compliance and interpreting digital financial data. But this power comes with responsibility. Privacy concerns, cybersecurity risks, technological dependence, and the changing role of commercial banks are real challenges. That's why future finance professionals won't just need accounting knowledge. They'll need digital literacy, ethical judgment, and an understanding of how technology and policy interact. Once you see this clearly, digital currencies stop feeling abstract. They become the next step in a long evolution, from gold to paper to cards to online transfers, and now to state-backed digital money. Now that you understand the intuition behind digital currencies and CBDCs, the next natural step is to explore decentralized finance and token economies, where money, lending, and investing operate without traditional banks at all. Stay curious, stay ambitious, and continue the journey with the Learning Studio. Your financial future starts here.